It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Markets to close. A bit of a pullback today in U.S. equity markets, a bit of a pullback in energy, agriculture, and metals. Abigail Doolittle, she's standing by right now with our commodities close.
We do have that pullback indeed, Romaine. A bit of a risk-off day. The Bloomberg Commodity Index overall down about 1.5%. Its worst day since the end of May, so let's call it 3 weeks or so. New York crude off of its lows down 1.2%. Natural gas, which tends to be a little bit more volatile on these risk-off days, down closer to 5%. Gold, though, the Haven down 1.1%, and then silver, both a haven and an industrial metal, well, it is down 3.8%. And Romaine, earlier you were mentioning the disappointment that investors seem to have about the slower rollout, the trickle effect of Chinese stimulus. Well, China, of course, is the world's second largest user of natural resources, so it seems to be weighing on commodities today for sure.
Abigail Doolittle there with our commodities close. There's been so much discussion about China and the role it plays in the global economy, but this week, India will be in the spotlight. Prime Minister Narendra Modi arriving in the U.S. this week for his first official state visit. Now, the trip comes as the U.S. is looking to distance itself from China, leaving India potentially as one to gain from the manufacturing diversification. Bloomberg actually spoke with veteran emerging markets fund manager Mark Mobius and asked, where would you invest $1 million? His answer, one word: India. Bloomberg's Suzanne Woolley did that interview, and she joins us right now for more on this. All right, Suzanne, I kind of understand, without even knowing exactly what he said, what his thesis would be, but explain what his thesis is.
His thesis is that the population in India is larger now than China, younger, and their economic growth is faster. Growth there is at 7%, where China is in the low single digits. So he just sees a very strong long-term growth story there.
Did he talk at all about this idea that just because you have a country with that type of scale in terms of population, that doesn't always translate directly into economic growth?
No. I mean, he has his own screens that he does. Like, he wants companies that have a return on capital of 20, which means that's a company that tends to have low debt. So, and he also feels that a rule of thumb he uses is that if a country like India has an economic growth of 7%, then a reasonably good company should be able to make 14%, have 14% growth.
So are there any specific sectors that he's focused on here, or just India overall?
He's very big on tech in general, a lot in software, a lot in semiconductors, but in India he likes a construction company called APL Apollo Tubes, which makes galvanized steel tubes. It's taking the place of bricks and mortar building. It's easier to construct. But he also likes a healthcare firm, Metropolitan Healthcare, and he also likes some software firms. He has a pretty wide range of companies that he likes in India.
What about, we have to kind of talk about the elephant in the room, and that's everything that's gone on this year with the Adani Group. There's been a lot of focus there, not only because of just the size of that empire, but of course its connections to the Modi administration.
Sure. I asked him about that, and I asked him if that lessened his enthusiasm for India, if he thought it had, a broader impact on enthusiasm. He said not at all. In his view, he said that the Adani family, everyone knew that the family itself was deeply involved in the company, that it was heavily leveraged, and he said, there was not extensive findings of wrongdoing. So he sort of said he's not going to write off India based on one company, just like he wouldn't do in the United States.
Yeah. So in the story, he talks about this idea of raising his percent allocation to India. You can't raise your allocation without doing it at the expense of allocating to something else. So what is he moving out of, or at least what is he lowering his allocation to?
He is lowering his allocation in Taiwan.
Taiwan?
Yeah.
Really?
Taiwan is his biggest allocation.
Okay.
He owns a lot of fabless companies there, a big play on high-end semiconductors that might benefit from AI. But his feeling is that companies there are maturing, and so he wants to raise his India stake from about 15 up to 20 to 25%, and the way he would do that would be by culling some of the Taiwanese companies that he owns.
Interesting. All right, well, this is a fascinating story, and obviously Mobius is a fascinating guy. He obviously makes bets on, of course, those less mature offshore countries and industries. That's how he's made his money. Suzanne Woolley, a great article here on the Bloomberg terminal that if you had $1 million to invest, where would you put it? Mobius says the real future is in India. Stick with us. A lot more coverage coming up here on the show here. We're going to focus right now on what's been going on with SoFi Technologies, down for a third straight day. This after 3 analysts turned neutral on the stock after that big, massive rally coming out of the end of that student loan moratorium. That's our stock of the hour. It's coming up next. This is Bloomberg.
News breaks. No one covers the world like Bloomberg.
On the AI question, what we don't really see is Apple doing a knee-jerk response and moving into the domain of generative AI.
Supporters of President Recep Tayyip Erdogan celebrating late into the night, dancing and singing.
We have a fundamental reassessment of everybody's capacity within OPEC. Should we talk about $95 and $100 oil again? Not for a while.
Bloomberg, your global business authority. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
You're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
All right, let's get right to our top calls. The big movers on the back of analyst recommendations. And we start off with Avis Budget Group, the car rental service upgraded to overweight over at Morgan Stanley. Adam Jonas saying Avis has shown it's able to extract higher revenue from its customers and lower costs for its own operations. The price target getting a bump to $230 from $182. The shares up 9% on the day. Next up, Philip Morris raised the buy over at Citi with the firm opening a positive catalyst watch on the stock and viewing the tobacco company as a front runner in the sector as it transitions away from those combustible products. Shares, though, only up about 0.5%. And finally, let's take a look at Ball Corp, upgraded to equal weight over at Wells Fargo following news that the company, which is best known, of course, for making aluminum cans, is exploring a sale of its aerospace business. And that business makes instruments, sensors, and radio frequency systems for spacecrafts. The analyst says that the risk-reward right now is much more balanced, given the potential for improved leverage should that deal go through. Nevertheless, Ball Corp taking it on the chin today, down 4% on the day, and those are some of our top calls. We do want to stick with the sell side here and focus a little bit on online lender SoFi Technologies. SoFi Technologies extending this fall after 3 firms cut the rating on the stock to hold equivalent. This after a big gain in that stock pushed it past the target levels of many Wall Street analysts. Here in the studio for more on his downgrade is Mihir Bhatia, Bank of America Global Research Analyst. He has a $10 price target on the shares. All right, let's talk a little bit here about what happened over the last few weeks here. The run-up in the stock price, that led you to say what?
Sure, yes. Firstly, thanks for having me on here. So the stock ran up a fair amount on the back of the debt deal that was agreed to by the Congress and the President. On that, included in the debt deal was the confirmation that the student loan moratorium would expire. When that happened, that's a positive for SoFi. So that improved the fundamentals because a large part of their business is student loan refi. So the stock ran up. It was up 100% in the past month. It approached our price target, and we thought it was approaching the fair value, and the risk reward was a little bit more neutral at that level, and hence we downgraded to neutral.
So let's talk about the longer term prospects here, because even prior to this whole student loan business, the moratorium and then whether it would be lifted or not, there were some concerns here about the company's business and whether it was going to be sustainable for the longer term here. When you look at sort of the balance and what they have on their books, what they're extending, and the current interest environment that we're in, what's the balance?
Sure. So, when you look at their books, what they've done a really good job over the last few years is diversifying their business away from student loans. So they started off as a student loan lender for the first, almost 8-9 years of their existence, and then they diversified away. They added personal loans, they added checking accounts, they got a bank license, added checking accounts, added savings accounts. They've really driven a lot of innovation on their platform and through their business, and as a result, they've managed to grow the company, and the company is on track to be profitable by the fourth quarter of this year, which is kudos to them. That's faster than most people expected. So management team has been executing very well there.
With regards to economic conditions and the expectation amongst a lot of folks, at least economists, who think we're headed for a recession or economic downturn, how does that affect the books like for a company like SoFi?
Sure. So SoFi is at its core a consumer lender and a bank. If we were to go to a recession, we would expect delinquencies, et cetera, to increase. The credit conditions would get a little bit weaker, the credit metrics. What is important, I think, to keep in mind, though, is SoFi really lends to the high-income consumer. The consumer, typical student loan is, over $70,000. It's people who have graduate degrees, who are typically, you tend to see employment metrics a little bit better in that category. That category also tends to have a little bit better credit performance just from income. They built up a bigger cushion on their savings accounts. So I would expect them to be a little less impacted than the typical consumer lender, which is maybe a little bit more subprime or prime focus.
Given the broadening out of this business, the diversification, if you will, who is their primary competitor now?
So you have to go business by business. So when you think about their student loan business, it's going to be the other private student loan issuers and refi. When you go on the personal loan side, it'll again be more of the personal loan companies. And then on the checking accounts and the bank side, they're really getting a lot of bank accounts. They're getting from the large, what they've said is from the larger banks.
Well, one reason why I asked that is there's been a lot of speculation, as I'm sure you know, about whether this would continue to be a standalone company, whether someone else, I should say, would be interested in actually buying it. Is that just pure, just random speculation?
Yeah, I think at this time, that would be speculation. I mean, they certainly have built a very interesting collection of assets. Everything we've seen, they're continuing to focus on growing. I think it would be a little bit speculative to speculate on M&A at this time. At the end of the day, it's a bank. I think if there's someone interested, it is interesting because it's an online bank. It's not like they have branches and it's a natural fit for geography.
Fintech. Come on, you have to get the fair enough. All right, Mihir, great to have you here.
Thank you.
Mihir Bhatia over at Bank of America, standing by. SoFi Technologies over the long term, though, downgrading that primarily on the back of valuation and the big run-up that we saw in the stock. Now, we do want to stay on the personal finance space, on the fintech space, if you will. KKR has actually agreed to buy up to $44 billion of buy now, pay later loan receivables from PayPal. The online payment company expects the transaction to generate about $1.8 billion in proceeds for it. Bloomberg finance reporter Jenny Serrain joining us right now to talk us through this here. Are these good loans?
So far, yes.
Yeah. Okay.
Yeah, they're unusual loans for consumer finance. So these are your, larger online purchases that consumers will use these loans to kind of break those purchases up, pay them off over time. They usually take about 8 weeks to do that, so they're very, very short duration. And so far, folks have been able to keep up with these loans pretty well.
So they said they're going to get $1.8 billion for this, at least the proceeds to PayPal here. Talk about the structure of this deal, because obviously the loans, I guess, technically are worth more than that, right?
Yeah, so it's a bit of an unusual one. So this is all part of a €3 billion loan commitment that KKR has made here. And so right now...
Sorry, just to stop, we should point out that all these loans are primarily overseas, not in the U.S. Right?
Yes,
okay.
That's a really good point. Yeah, so these are all European loans that PayPal has been making for the last 3 years or so. And yeah, so it's part of this bigger loan commitment that KKR has made where they're buying the bulk of the business now. And then over time, they're going to agree to buy up to 44 billion euros more of these loans. And so it's a multi-year agreement. This is a long-standing partnership that they've set up today. And it's really, a sign that KKR is ready to kind of put its private credit ammunition into the consumer finance business.
Talk a little bit more about that, because again, I hate to be like the Debbie Downer, but if you do believe the economists who think we're all headed towards a recession here, why would you want to embrace something like consumer loans in this environment?
I think it's a great question, and I think it'll be really interesting to kind of see how this turns out. We've never really seen a deal quite like this one, and these loans are really unusual. So, like I said, so far consumers have been largely able to keep up with them, but there's a lot of question marks around how they survive the downturn.
And you've been covering this well, and just so our viewers understand, when we talk about these buy now, pay later loans, and I don't know if it's specific to PayPal, but industry-wide, we know that the credit standards that were applied were certainly less than maybe if you had went to apply for a credit card at Goldman or JP Morgan Chase, right?
Yeah, a lot of times they even tout that they don't use credit scores or some of the other traditional measures that banks would use for credit cards. So
how do you measure whether these are good loans or not?
It's a good question. I think a lot of it comes down to the fact that they start out with really small lines, and if you fall behind, you don't get to take out new ones. So unlike a credit card where once you fall behind, it comes with like this almost a vicious cycle, these have more of a emergency brake system, if you will.
Emergency brake system here. Do you expect that we're going to see other deals like this, meaning some of these private equity, private credit companies coming in and buying this type of stuff?
I think it'll be interesting to watch. PayPal, for its part, has said that they're still looking to get rid of, a big chunk of these loans, and so we'll have to see what they do, especially here in the U.S. They still have a large portfolio here, so I think there's more to come. Not sure if private equity will always be the answer, but it's an interesting space for sure.
Private equity will always be the answer. Haven't you spoken to our viewers?
I know.
Jenny Serrain there, a Bloomberg finance reporter. Interesting story here with KKR agreeing to buy up several billion euros worth of PayPal's buy now, pay later loans. Stick with us, because we're going to continue our discussion about private equity. They are the now and potentially the future, but apparently they got caught out by the rapid rise in interest rates. Guess what? Jay Powell told them he was going to raise interest rates, and they didn't believe him, and now they're having to reckon with that decision. That's the Bloomberg Big Take. We'll cover it coming up after the break. This is Bloomberg.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
All right, the rapid rise that we've seen in interest rates is now starting to cost some of the titans of private equity billions of dollars. It's also increasing the threat of their companies going into default. That's today's big take, and joining us for now is Allison McNeely. She's Bloomberg private equity reporter. This was an interesting story, mainly because you sort of scratch your head through several points here as to how they did not anticipate or did not prepare for the fact that the Fed was going to raise rates aggressively.
It's a really great question, and I think it really is a great example of how quickly the Fed raised interest rates. You know, and just the fact that it was unprecedented, it was unexpected, and really kind of caught a lot of these private equity firms and their underlying portfolio companies off guard. You could say maybe they should have known, but I think it actually just sort of further emphasizes how dramatic the shift has been.
I am curious because Jay Powell started jawboning the market long before they actually did the first rate hike back in March of last year here. Now, maybe they didn't believe that rates would go up this much, but they certainly must have known that rates were going to go up to some extent, right?
Yeah, I think it sort of is an interesting reflection of sort of the past decade that we were just in. So people kind of forgot about the importance of hedging. Interest rates were so low for so long, and people were investing in a very different environment that, yes, arguably they should have known. They should have listened to the Fed more closely, but they didn't.
Well, so talk a little bit about how widespread this is. I mean, is this pretty much across the board with most of these private equity firms?
The vast majority. Yeah. Some research firms have looked at this issue and found that in the U.S., nearly 75% of firms with floating rate debt are unhedged. In Europe, it's about 70%. So yeah, you're looking at majority.
But I've had this conversation with a lot of these folks, and they'll tell you, very positively here, that the floating rate nature, and we should point out most of these deals are floating rate in nature if you believe what they say, that provides them some degree of protection. Does it?
I mean, for the borrowers, it doesn't, because essentially, if your debt is floating rate, that means it's gotten more expensive.
Right.
And where that is potentially a problem is essentially if your interest costs versus how much money you're bringing in, your earnings become more and more out of whack, and essentially your interest costs eat more and more into your earnings.
So this gets to the whole issue of potential default, right? Because if you're the lender here, yes, floating rate works to your advantage, but if the person or the company you lend to somehow can't pay the interest anymore, then at some point you're going to be left holding the bag.
Exactly. It's all well and good as a lender to have higigher interest rate costs. You're getting paid more to take risk. But if the borrower that you're lending to can't keep up, then it's a problem. KKR's Envision, the healthcare staffing services company, is a great example of that. Envision had a bunch of different problems kind of working against it, but one was the hedging costs, and they simply could not find a counterparty that was willing to hedge their floating rate debt at a level or a price that was affordable for the company, and so that was ultimately a factor that led to it filing for bankruptcy.
Wow. All right, Allison McNeely, great story here on the Bloomberg terminal today. It is the big take, a focus here on some of the hedging failures by some of the big private equity firms, basically not really betting on the idea that rates would go up or go up as fast as they did. All right, we want to pivot from that to the world of airplanes. Second day of the Paris Air Show. We actually heard from the RTX CEO a little bit earlier with Guy Johnson. Take a listen.
Probably end of next year, I would say. Again, Airbus, we try and stay in lockstep with Airbus in terms of their production. Yep. And, they have many challenges besides engines. They have a number of shortages out there, but we work very closely, literally day to day with them in terms of making sure that they have engines on dock when they need them.
The amount of demand, as you've already pointed out, is that demand sustainable? Are we seeing some of these orders maybe representing over-ordering at this present in order to secure delivery slots some way down the road?
Well, Indigo's a great example, right? 500 aircraft, right, on top of the aircraft they already have on order. Yep. Those aircraft will not be delivered until 2030 to 2035. Right now, if you want a new A320, you can talk to Guillaume at Airbus, and he would tell you, I'll give you that aircraft in 2030. So I'm sure part of this is securing production slots for the next decade, but growth is real. I mean, we're still seeing 4.5–5% revenue passenger mile growth year after year. And Airbus came out with a study last week and said 44,000 new aircraft in the next 20 years, and half of today's fleet of 28,000 gets retired. If you do the math, that means you're going to double the size of the fleet in 20 years. That's a lot of aircraft.
You got some work to do.
We all do.
You bring up Indigo. Indigo is a good example that I think of what people are talking about when it comes to your company right now. India's a tough operating environment for the GTF. Does that put you behind in terms of the competition supply engines, or do you think by the time we get to the delivery of those aircraft, you'll have the Advantage, you'll have, which is the new GTF engine coming through, and as a result of which this is a non-issue?
So the issues that we're having today, which is the same as the competition, in these very harsh operating environments, call it India, the Middle East, China, where you have heavy particulate emissions in the air, with the increased operating temperatures to get to fuel efficiencies, we are seeing problems with deterioration in the turbine blades, because all of these particles get sucked into the turbine and they close up the cooling holes. We'll fix that with the Advantage engine. We'll put more cooling and solve this. The Advantage comes into service late 24, early 25. So by the what we're talking about in 2030, this should be well behind us. I think what's important is you think about the GTF, and I know there have been a lot of headlines about reliability. Two points I would make. One is we know how to fix the problems that we have out there. 75% of our operators operate in benign environments and are not seeing these issues. But if you're in India or if you're in China or the Middle East, and again,
but Airbus is selling a lot of planes there right now.
They are, and it's an issue. And so again, we're going to solve it.
Craig Hayes there, CEO of RTX, speaking with our very own Guy Johnson at the Paris Air Show, actually first in-person one we've had in about 4 years. Meanwhile, back here in the U.S., as we get ready to set up for the final hour of trading here on this holiday-shortened week, stocks are on the back foot, of course, coming off what had been a phenomenal run, 5 straight weeks of gains for the S&P 500, but we're caught up in a little bit of a global sell-off. Part of that, some concerns here about the lack of...
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
And a very good afternoon, everybody. It is Tuesday, not Monday. It is Tuesday, June 20th, 2023. Carol Masser, along with Matt Miller. Tim, as you know, is on leave. This is Bloomberg Business Week on YouTube, on Bloomberg Originals, in our Interactive Brokers studio. What do you got for me?
Well, I'm just looking forward to the program. We've got a lot coming up, including we're going to focus in on cars, which I love. You know, more companies adopting Tesla's charger network, which should be great for EVs. Is he not
brilliant or what?
I mean, that was a stroke of genius, I would say. Investing early in a charging network that no other companies or governments to this day still really invest that much in. Plus, you add the fact that we have a new estimate for the total size of the EV market. $57 trillion by 2050.
That's a 2050.
It's a long way off.
It's a long ways off. Hey, you know, things like that can change. We're also going to get into the semi company that's propelled into the stratosphere and into the alpha pack of Silicon Valley. We are talking about NVIDIA. We're going to tell you about everything and anything you need to know about that company.
Yeah, I mean, we'll continue to cover NVIDIA like we do pretty much every day.
I feel like it's one of those, right? We do kind of say it every day.
And then the housing market, or to me, the real estate market is such a huge story. You've got the bomb housing number here, housing starts number here in the U.S., and I mean that in terms of explosive, upwards, like unbelievable beat. Plus, you've got a real estate market that continues to falter in Sweden and in the U.K. You've got real problems in China and no stimulus there. So globally, I think it's a real problem.
We're also going to talk about hedging. I thought that was kind of 101 risk management if you'd got an MBA, and yet it just might be a coming stress point for the PE world. I love everything to do, as you know, with private equity, private credit in particular. We've got FedEx earnings after the closing bell, and then we're going to talk about the bloody rivalry between two ruthless retail juggernauts that are not accustomed to losing. Those are the words of Brad Stone, who knows something about one company in particular.
Yeah, Amazon, right? So it'll be very interesting to talk. I love the Business Week segment the most.
All right, countdown to the close. It starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. 60 minutes left to go here in the trading session. Romaine Bostic joined now by Scarlett Fu, as well as our colleagues Carol Masser and Matt Miller. Welcome to our audiences across Bloomberg Television, Radio Originals, and our partnership of those folks streaming on YouTube. Carol Masser, we're coming off what had been a really, really good week of gains, and really good 5 or 6 weeks of gains overall for the broader market, but a bit of a pullback, some softness here on this Tuesday.
Yeah, I almost wonder if we're, kind of waiting once again for Fed Chair Jay Powell, who's going to be up on Capitol Hill the next couple of days. Maybe some clarification in terms of rate policy and his intentions. Having said that, one thing I like to look at, it's really continuing to be tough times when it comes to those Chinese names that trade here in the United States. So let's bring it up for everybody, because we are down in terms of U.S. equities, but down in a big way when it comes to Chinese names that trade here in the U.S. They're down about 5%. If you look at the Golden Dragon China Index, look at PDD. This is one of your biggest decliners in the NASDAQ 100, down almost 8%. JD.com's down about 7%. Alibaba, a very specific story, bringing back 2 of Jack Ma's longest-serving lieutenants. Jack Tsai, certainly a familiar name, also Eddie Wu, and that's kind of an interesting story, but it's still down about 4.5%. China down because there's disappointment. China State Council failing to issue specific support measures, and banks offering modest rate cuts. So disappointment.
I can't tell if you're joking with me. Are you actually just poking fun at me? Every single day, all you want to talk about at 3 o'clock is Chinese stocks that trade in the U.S.?
But I look for things that are really moving in a big way. And I think we cannot ignore what could be severe disappointment in terms of growth for China. Matt, hey, FYI, it's important to the global economy.
I think a lot of people decided a while back that China was uninvestable, so they're ignoring it. But you definitely are not in that camp.
Nope.
I'm looking a little bit closer to home.
Hey, where was Antony Blinken, by the way?
He was in China, yeah.
Oh, yeah.
Decoupling.
All right.
I'm looking at...
we're still here, right?
Yes, we do. We do. We're coming back.
I'm looking at a little closer to home. We had a housing market, and remember, Aviel, I didn't want to look at the broader advance, but rather the housing market chart that I sent to you and Queenette there. The housing market really beating estimates, like an 11 sigma move, beating the highest estimate with housing starts. And that is my focus today, because if you look at, when you go to the GRR, you're going to see that consumer discretionary stocks are doing well, and the consumer discretionary stocks are like KB Home, Lennar,
you're stealing
Pulte.
my thunder here. Let's go there.
I don't want to
No,
steal it.
let's go over to GRR. Romaine, do you mind if we go straight to GRR?
Yeah, sure. Do whatever you want.
Let's look at group ranked returns, since Matt brought it up. Indeed, it is home builders leading consumer discretionary stocks higher, along with Tesla. Tesla is a big reason why that group is gaining. Remember, consumer discretionary includes auto-related companies, retailers, and home builders. Healthcare, the other sector that's in the green. And on the downside, the cyclicals, energy and materials. It goes back to what Carol was saying about China, the disappointment with the smaller than expected rate cut, and real estate also losing 0.9%.
We take a look at some of the individual movers. Of course, everyone focused on those big cap tech names. Apple had been trading potentially at a fresh record high. It's still kind of struggling, trying to straddle that line right now, just a little bit shy of that right now, up about 0.3% here on the day. Meanwhile, Microsoft, which had been one of the big leaders over the last few weeks, down about 1% here on the day. And I want to talk about some of the solar companies, because I've been really kind of digging around for information. SolarEdge, Enphase, a lot of these renewable power companies are lower on the day. SolarEdge down about 8%. There is a conference taking place over in Munich, and there does appear to be some commentary about softness in the European market for solar sales, as well as concerns here about Chinese supply and the idea that that supply might be too high. So basically some imbalances there again, but we have no official reporting yet by Bloomberg, but we'll keep an eye on that. And then, Matt, you were just talking about the home building sector. D.R. Horton at 118.04 right now on your screen, up 1.4%. That would be a record high. You flip up the board here, and we talk about the home building sector as a whole. That is at a record high, and a big part of the reason here is because of that big jump that we saw earlier today in housing starts. An unexpected jump, at least unexpected at the magnitude that we got on single-family homes alone. We were up about 19%, and overall, we were up more than 20%.
That's the chart I wanted to use.
Well, there you got it.
I'm glad it's up.
There you go.
All right. All right, well, that's an important data point, right? And maybe Jay Powell got it right, about housing maybe starting to stabilize. I think he had talked a little bit about that.
He said it bottomed.
Yeah, so if we're seeing stabilization, right, and we've got that data point, you do wonder what else we're going to get from Jay Powell when he's up on Capitol Hill this week, right? We're going to hear from him tomorrow and also on Thursday. Having said that, weighing in today on kind of his thoughts about the market and risk within the market, specifically fixed income, is Matt Miskin. He's co-chief investment strategist at John Hancock Investment Management, earlier on with Lisa Abramowitz on Bloomberg TV. He says investors aren't factoring enough when it comes to worries. Here's what he had to say.
There's just not a lot of risk being priced in. And right now, the time to fix a roof is when the sun is shining. When we look at portfolios that have been overweight risk, that have actually done well this year, you've had to have real risk on to do well and outperform this year. We would look to trim into some of this strength and redeploy into higher quality fixed income, take some chips off after such an exceptional run.
All right, Matt Miskin over at John Hancock Investment Management. But you do wonder, either, whether you're looking at fixed income or, certainly the run-up that we've seen in equities as of late, you do wonder, Matt, whether or not investors are factoring enough risk about the outlook going forward. There's a lot of complacency we've seen in the market.
Yeah, I mean, you could say that for sure. Look at the flows into equity ETFs. U.S. equity ETFs have just shot up over, for example, if you compare them to flows into fixed income ETFs. So I think they're chasing a rally a little bit too late in that instance, but you do see a little bit of FOMO going on in this market.
Yeah,
for sure.
Citi says the positioning in U.S. stocks is the most bullish since 2010, but there was another note out that raised some interest here as well, which is that there's going to be some rebalancing of asset allocation flows as we get towards the end of the month, the end of the quarter, and the end of the first half. People are going to be moving money into bonds, out of stocks, and that could knock 3 to 5% off of global stocks, according to JP Morgan Chase.
Yeah, I mean, you could just look at the differential. I mean, it's pretty clear here when you look at the gains that we've seen in the equity market versus what we've seen in the bond market. That gap has to be closed. And this is, I can't remember, I have to look up the exact data here, but there was some a great note out last week that just showed you just how wide that gap was on a historical basis. So this is going to be an interesting rebalance here at the end of the month.
All right, guys, we're going to call it a wrap for now. We'll be back in less than an hour's time. Our cross-platform coverage, radio, TV, Bloomberg Originals, and of course, YouTube. We're going to count you down to the close on this Tuesday. Join us for Beyond the Bell at 4 p.m. Wall Street time.
No, you're not alone, 'cause I'm gonna make this place your home.
All right, everybody, we just talked a little bit about the housing data, certainly, that we got here in the U.S. U.S. housing starts unexpectedly surging in May by the most since 2016. Applications to build increased, suggesting residential construction is on track to help fuel economic growth. In the U.K., Matt, we've seen house prices fall about 13% in real terms from March 2022. That peak then, that's according to Bloomberg Economics, our European economist, Niraj Shah. And then you certainly highlighted something about what's going on in Sweden specifically.
Yeah, you're seeing a real crisis there with real estate funds that are starting to fail, and we've had a couple of big failures there. And in China also, a real loss of confidence in owning property as a reliable or a safe asset. So globally, I think there's a real estate concern that made me wonder whether these housing starts aren't a little bit too speculative, and it could mean maybe bad news down the road. But if you look at the share prices of,
home builders,
the home builders, they're doing incredibly well. So I guess investors aren't worried.
All right, so let's get to it. Let's see what our team has to say. Bloomberg News economics editor Molly Smith in our Interactive Brokers studio, along with Bloomberg News reporter Simone Foxman. So Molly, kick it off for us. Talk about this housing data we got today. It seems really bullish. What does it really tell us?
Yeah, and I think, I can understand a bit of the hesitation on Matt's part there, but the thing is when we're looking at housing sales data right now across the country is that all the action has been with new home sales. So you can see that builders are following that demand and breaking more ground on new construction because people who already are in their homes are so hesitant to list. They've probably locked in low mortgage rates from a couple years ago, and they have no interest in trying to back out of that right now, the lock-in effect that we'd call it in the real estate world. So it makes a lot of sense from that perspective. Obviously would want to see it more than just one reading to see if this is a trend that would hold. But if it did, that'd be really positive for GDP.
Do we know how much of these starts are speculative? Do people still build on spec, or is that a thing of 2006, 2007?
I can't tell that from this report, at least. So I'm going to stay quiet on that one.
No, it is interesting, right? Because we did talk about what Jay Powell had to say. Simone, come on in on it, because first of all, on the U.S. side of things, you caught up with, I think, the CEO of Lennar. Is that correct?
The chairman, the executive chairman there. And he was talking about, there is no desire by existing homeowners to leave the 3-4% mortgage rates they have. But there are all these people that lived at home with their parents for a very long time that are now finally getting around to having families. They want to move out, and there is simply no new stock, and that is why you are seeing, particularly on the more affordable ends of this piece, these new homes, there is a long-term sort of generational shift here that we're likely to see over the next couple of years. Maybe we don't feel it for the next year or so as interest rates remain high, but when we move out of this, there's a real affordability problem in U.S. housing, and that's
But so
something
is
that's gonna catch up
Lennar
with
then
us.
building starters? Because every time I talk to somebody from a home building company, they're putting up McMansions, because they say, yeah, we could do starters, but there's not as much of a profit margin in that as the bigger price tag homes.
Yeah, I mean, look, it's a little bit on all sides, right? You have this barbell effect of the people who want really expensive homes, and the both millennials who are just starting out their first homes, as well as retirement age people, the boomers who are now retiring, who want the smaller stuff. And a lot of this is a zoning issue. It's not as much of a profit margin issue. They're just simply not allowed to build houses in so many places. And so, you hear Lennar, you hear a lot of the other home builders really appealing to cities and saying, let us
commodity land, right?
Right. Yes, these are small. These are maybe not. These are affordable homes, yes, but these are strong buyers that are going to spend money in your town.
So Molly, come back in on, in terms of housing data and how it applies to economic growth, and how something like a housing starts number, we can think about it more broadly in terms of growth momentum.
Sure. So this would be the part of GDP that we call residential investment. So when you look at some of the biggest drivers of GDP, obviously consumer spending is the biggest one by far, but residential investment not too far behind. And that's what's been a real drag on growth for the past 2 years, as we've seen home prices skyrocket and mortgage rates go up, and just not a whole lot of momentum in the housing market. But this would be, if sustained right now, obviously we're looking at, for now, the second quarter of growth. So this would be for the May data. We would still have to incorporate April and June into that as well. But that would be, if sustained, the first positive contribution from residential investment to GDP in 2 years.
Why now? Why do we see all these starts all of a sudden? I mean, someone described it to me as an 11 sigma move, which I don't really know what that means, but I'm guessing it's like, in terms of standard deviations, it's like amazing. I'm sure Tom Keene understands that. But it was higher than, the new housing starts were higher than the highest estimate in our survey. So why all of a sudden this month?
I think it takes time for some of these other data points to filter through. Home builder sentiment has slowly but surely been coming up, and it takes time to also break ground on projects, to Simone's point about the zoning concerns, and to find where all of this land is going to come from. This doesn't just happen overnight.
Home builders don't want to buy too if there's not going to be people to buy. They don't do that anymore.
I think there was a lot of it too, of waiting to see what was going to go on with mortgage rates, and are they really going to stay this high all year, and are we going to maybe start to see them come down as inflation is easing? And now that it's all right, we're buckled in, we're maybe going to get another 2 increases. People have kind of settled in, realized that this rate is the new normal for now, and
or this might be better than
this might be better where it's going.
Months.
Exactly.
Yeah, new normal is certainly, I think, the phrase of the day. But if you want me to broaden this out a little bit to particularly Europe, which is feeling some of these same pains of interest rate increases, it's not every city that is seeing housing prices drop. You look at London, for example, home prices are actually up 1.1% year on year. There's simply, again, as in the United States, some limited stock of housing. You have also the foreign buyer element that comes in London. Madrid is the same way, up 5% year on year. At the same time, though, you're looking at places like Sweden, where we've seen double-digit drops in home prices. So I think it's a really divergent story, from city to city in Europe. Even though we're hearing all these, headlines about property woes, that's not consistent.
And state to state in the U.S. too. You can't really speak about the U.S. housing market as a whole country. You know, you look at San Francisco, and that's a much different...
Location.
Well, you look at San Francisco, and that's a much different picture from, say, Austin or Miami right now. So also tough to, you know, paint it with a broad brush.
It's really interesting. I just wonder, you know, how sustainable the housing market here is, especially at these prices with these rates. I know Jay Powell said we hit a bottom, and if the Fed chair says you hit a bottom, you might as well go ahead and buy. But it just seems like we could come sliding down. If those people who are locked into their homes have to sell, they're going to have to accept much lower prices than they probably want.
Sure, and prices, I mean, have been coming down here, at least, like, you know, from the peak, which was last year. So in that sense, like, yeah, that probably will happen. We'll get some more data on that this week on the existing home sales data for May. Next week, look at a new home sales data, and that's really, like I said, where more of the positive activity's been coming from.
I think it feeds into, though, this idea that there has to be something else in this economic downturn to really, you know, pull the floor out of housing. You either have to see a lot higher margin interest rates, or you have to see some commercial lending stress. I mean, that's kind of the concern we've seen in Sweden. You know, we were talking about SBB and these other, they call fallen angels. A lot of them had a lot of exposure to the home market, to home rentals and that sort of thing, and running these commercial residential properties have been very impacted. But the concern there is that the banks have a lot of this on their books. And so then, you know, if you have these fallen angels impacting the banking sector, then you see sort of another leg down. And then, you know, where does we go from here? And you know, there are green shoots in the Swedish housing market as well.
Are there green shoots in China? What's your just kind of 30-second quip on that?
I mean, it looks like, and Bloomberg Intelligence has a great note about this, cuts to interest rates aren't having the same bounce back factor in China that they used to have. And therefore, if home prices only go up 5% this year, that isn't really helpful for all those people who've been betting that home prices would surge back.
Well, it used to be a sure thing, right? Like this whole idea of kind of creating some property wealth.
And therefore you get this angsty consumer that doesn't want to spend because they've seen the value of their assets, their home wealth, their wallets not increase in the way that they expected.
I mean, I think the Chinese have to come in and do something about their property market, right? That's what everyone's waiting for, and they're not doing enough. So
I think the assumption is, right, that they will, because that they always seem to come to the rescue. But
the things they used last time, they're just not working as well. And how much more do you want to do?
Molly, 30 seconds. Fed Chairman Jay Powell up on Capitol Hill. In terms of housing, are you watching out for anything? Just quickly.
I don't know if that's so much the focus in the next 2 days. I think everyone was really still pretty surprised about the projections that we heard last week in the June in the new material that the Fed released. So yeah, would definitely want to hear, like, again, how do you kind of explain this message of why you paused at this meeting, but you still see 2 more hikes for the year? I think that's still going to be the challenge in conveying that message.
And did you mean skip? Come on. Did you mean it?
I mean, he said it's not a skip, so we can't call it a skip.
We might finally get that answer on the Grateful Dead song, too.
I think, well, maybe I'll see him at the shows tomorrow and Thursday at Citi Field.
Molly Smith, Simone Foxman of Bloomberg, thank you guys so much. Bloomberg Business Week on Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:21 on Wall Street. We do check markets all day long at Bloomberg. The Dow, the S&P, NASDAQ, all in the red. 39 minutes to go ahead of the closing bell. Stocks are slipping as the second quarter rally meets resistance from economic headwinds and signs of stretched positioning. The S&P down now by 20 points at 43.89, a drop of about 0.5%. The Dow is down 226 points, down 0.7%. The NASDAQ Composite Index down 30 now, a drop there of 0.2%. 10-year yield 3.78%, with the 2-year that is yielding 4.69%. Spot gold down $13 the ounce to $19.36, drop there of 0.7%. And West Texas Intermediate crude down 1.8% at $70.50 a barrel. Now, what about the odds of a recession? Ethan Devitt is Chief Investment Officer at Meta Group Investments.
So we may have a technical recession. We may all feel a little more glum because certainly consumer sentiment has been divorced from some of that hard data. But as long as the employment picture stays solid, I do believe that we will avert a recession. But there's going to be some pain in there. There will be bankruptcies, there will be restructurings. But overall, I don't think we're looking at that kind of catastrophic outcome that we saw in 08-09.
AT&T's Chief Financial Officer says second quarter phone subscriber growth will be lower than analyst estimates due to competitors' price moves and the loss of a federal contract. Right now, we've got AT&T shares lower by 1.25%. Again, recapping, stocks are lower across the board, with the S&P now lower by 19 points. That is a drop of just about 0.4%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Thank you so much, Mr. Pellet. Carol Massar along with Matthew Miller. Matt in for Tim, of course, here on Bloomberg Business Week. So many buyout firms considered hedging against rising interest rates a waste of time and money. Their debt-laden companies, well, they're now paying the price. Obsessed, as you all know, I am about private credit, and this is a story that is our Bloomberg Big Take on the Bloomberg Terminal, and it's among our most read on this Tuesday, Matt.
Yeah, absolutely. It doesn't make much sense to me that people would
Did everybody
not hedge
think rates were going to
floating
stay
interest
low
rate
forever?
debt. Yeah, exactly. I mean, if you've got it locked in at zero, fine. But if you're going to see floating rates, you've got to hedge that risk. And I can't imagine any excuse for not doing it.
All right, so let's get to it. It's a great story, and Silas Brown is private credit reporter at Bloomberg News. Lucky for us, staying up for us. He's on Zoom in London. Silas, thanks for staying with us. We are obsessed with private credit. I am obsessed with private credit because I just think we don't have all the transparency we need. Tell us about your story, and as Matt says, these floating rates, and then a lack of hedging among private equity firms. What's going on?
Well, firstly, clearly I'm in the right company because I'm obsessed with private credit as well.
Yay.
So that's good. Yeah, I mean, to add to Matt's confusion, it was also the case that hedging was very cheap back then, whereas now hedging is very expensive.
Back then, not so long ago, though, right?
Yeah, back then I don't mean in the kind of 1970s. I mean, 2 or 3 years ago.
Right.
What we quote a hedging specialist who says that hedging costs have gone up by, as much as 200 times. To hedge a 500 million euro loan 3 years ago would have cost around 50,000 euros, and it now costs 10 million euros.
Unbelievable. And these guys are, that's what they're paying for a weekend of grouse hunting. I mean, I can't believe that they would miss that mark.
I mean, I think why I like the story, and maybe this is because I'm somewhat of a, I don't know, either hopeless romantic or a kind of layman. But I mean, I think it speaks to human nature in that, you become lulled into this false sense of security that rates will remain persistently low. And then even when rates go higher, you think, well, maybe it's transitory and maybe therefore I shouldn't hedge and lock in rates, and yet they still keep on going higher. And then you find yourself in quite a troubling position where
just ask the U.S. regional banks, right? I mean, everybody just. So do me a favor. Bloomberg is so good about size and scope. Give us an idea, because you have a number of about private equity firms, I think, with about $3 trillion in floating rate debt from rising interest rates.
I mean, it's they cut it loads of different ways, and it's a rough approximation. But I mean, basically that kind of includes leverage loans and direct lending and private debt as well, with a bit of floating rate high yield debt thrown in as well. So it's not an insignificant amount. I mean, the harder figure to find is quite how much of it is hedged. Private equity firms and their companies are under no obligation to tell people like me whether or not they're hedged. Moody's and I mean some of the ratings agencies have done some work on it. Some of the banks, large institutions, have got some work on it. I mean, but I mean, by and large, the consensus is that it's a majority that was unhedged.
Silas, I'm sure it's far too complicated to explain it to a numbskull like me. But how exactly would you put on a hedge if you're talking about loans that have floating interest rates? How do you hedge against that?
So I mean, I think the real purists among hedging would simply find a counterparty that would fix the floating rate. So you would switch floating rate risk to fixed rate risk. The a la mode hedging position is to get caps, and I think that it's a kind of cheaper way of doing it as well, where above a certain threshold you don't go further. So there was a few private equity firms that got ahead of this, namely Bain Capital, that got 1.5% and 2% hedge caps, and Carlyle, that was the European wing of Carlyle, that got 0% caps on Euribor, but Euribor was lower than the reference rates in the US.
Silas, what I'm always looking for is like the black swan or the other shoe to drop. And I guess what I found interesting about your story is that our concern is if a company that has a private credit loan, and it's too expensive and they can't make the payments and they default and they go down, yes, it's a loss for the private equity investors. Okay, that's the risk they take. But it's a company that gets shut down. It's workers who lose their jobs. And I do wonder, we've already kind of talked about it being systemic in another interview, and people aren't really that concerned. But there's fallout, right? And it's a global potential fallout and impact on the global economy.
Yeah, and I think in fairness, not to do my article down, I mean, I think the lack of hedging should be, and the trouble that causes, should be thought of alongside this kind of smorgasbord of other difficulties that companies are facing, either like soaring energy costs or wage inflation, but also higher borrowing costs across the board. I mean, the end of easy money. And so, yes, I think failure to hedge in that regard and in this economic climate isn't great. I think that, but I do think that were a company to default, I think it may well be the straw that breaks the camel's back, but I think it will be alongside a number of other difficulties that the company is facing.
Silas, I wonder, I think Americans typically think more about fixed rate loans than Europeans do, because your mortgages a lot of times are floating, right? Or they're fixed for a short period of time and then you have to refinance. That's
I am a holder of a fixed rate, but then floating of a mortgage. So yes.
So I wonder, but in private credit, the loans that if you're giving out private credit, those are floating. I wonder if private equity funds are now starting to offer fixed loans because we're at such a high point already. They only stand to gain if they can do that and rates come down.
That's a very interesting question that I should be posing to all of my dear friends on the private equity side. I mean, I do think that as rising rates, as rates rose, private credit kind of were real champions of it, because they're now seeing double-digit gross returns for loans that seem comparable to loans that they were that we were offering a year before. So I do think that there is a natural hedge for the direct lenders and for leveraged loan investors in that the instruments that they use are floating rate. And I think they are, to a certain extent, beneficiaries of the rising rate environment.
Yeah, you said in your story, interest rates on the largest U.S. leveraged loans hit an average of 10% this month from 3.9% at the end of 2021. So that's 10%. A big difference. Yeah.
So, I mean, the concern there, of course, if you're a direct lender, is that your counterparty starts going bust, right?
Yeah, that's exactly right. And there's a degree of wiggle room that they can provide. I mean, they can either pick some of the interest or do these kind of quirky kind of debt maneuvers. But yes, you're exactly right. I mean, how long can direct lenders champion rising rates before it starts to bite the companies that they're lending to? I mean, that's certainly something that in our reporting we're thinking about quite often.
Right. And you also kind of get into some of the companies that have already, got into trouble. Really great piece of reporting, and we really appreciate you staying up. So thank you.
Thank you. I love your artwork, by the way, Silas. That is tremendous stuff.
We're checking out the walls.
Oh, right there. Yeah, exactly. Thank you.
All right. Be well. Have a good evening. Silas Brown, he's private credit reporter at Bloomberg News on Zoom from London. Is that his artwork?
Well, maybe when Silas was a much younger chap, he painted those.
Is he Czechoslovakian?
Silas?
Did you say Czech?
Chap. I said chap. You think everybody's a Czech, a fellow
I'm actually a
Czech.
Slovak. All right, let's get a check on world and national news. There is a difference. Here's Nancy Lyons in our Bloomberg 99.1 newsroom. Take it away, Nance.
Thanks, Carol. Secretary of State Antony Blinken, fresh from his talks with Xi Jinping and other top Chinese officials, is in London for a conference on aid to Ukraine.
At his news conference, Blinken was asked follow-up questions about what was accomplished in China.
As we have more members of our own government going to China, Chinese officials coming to the United States, you'll see the benefits of that, at least in stabilizing the relationship. China also sees a utility and importance in having greater stability. It would be irresponsible not to engage.
As to Ukraine, Blinken said the aim will be to create the conditions, military, economic, and democratic, to encourage private capital to invest in post-war reconstruction. In Washington, Irv Chapman, Bloomberg Radio.
U.S. Coast Guard crews based in Boston are assisting with the search for a missing submarine that was headed to explore the Titanic wreckage. The submarine, with 5 people inside, made the dive on Sunday and lost contact with the vessel after less than 2 hours. Coast Guard Captain Jamie Frederick.
With C-130 aircraft searching by sight and with radar, and subsurface with P-3 aircraft, we're able to drop and monitor sonar buoys. Those search efforts have not yielded any results.
Captain Frederick and others believe the submersible has less than 40 hours of oxygen left. Search efforts are focused on about 900 miles east of Cape Cod, Massachusetts. A judge still needs to sign off on the deal, but Hunter Biden will apparently plead guilty to tax charges and a gun charge in an agreement with federal prosecutors. The president's son will plead guilty to a pair of misdemeanor tax charges involving about $1 million in unpaid taxes several years ago. Federal prosecutors in Delaware will drop the felony charge for possessing a firearm or being a drug user if he completes 2 years of probation. Global news 24 hours a day.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:40 on Wall Street. We do check markets all day long at Bloomberg. The Dow, the S&P, NASDAQ 100 index, and the Russell 2000 all in the red. Let's head right over to the First Word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. That's right. U.S. stocks in the red from the start today, with the Dow currently down 222 points. S&P's dropped 19, and NASDAQ is lower by 18. The U.S. 10-year yield at 3.73%. Gold is down 13. Oil is fading. And Bitcoin is surging by 5% as a new crypto exchange backed by Citadel, Fidelity, and Schwab went live today. Of the main 11 S&P sectors, only consumer discretionary and healthcare were in the green. Energy was under pressure. And leaders to the upside in the Dow, UNH, Salesforce, and Merck, while Intel fell 4% and led to the downside. In deal news, Eli Lilly to buy Dice Therapeutics for $48 per share in cash. And in other news, AT&T sees phone subscriber gains falling below estimates. Wrapping things up, FedEx reports after the bell. Live from the First Breaking News Desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill Maloney. And to hear live breaking news over your Bloomberg, type Squawk, SQUA, on your Bloomberg terminal. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, everybody, we've got just under 18 minutes left to go until we wrap up the Tuesday trade. Carol Massar along with Matthew Miller. Matt, of course, in for Tim. Let's get to it. Let's drive to the close because, I don't know, Matt. We're off our lows on the equity side of things.
I'm pretty pumped, actually, because our next guest is someone that I heard on Brian and Doug's show. And, you know, I go home and I listen to Brian and Doug's show, and when I hear a good guest, I like write it down in my car, and then I try and steal them the next day.
Hey, Siri.
Yeah, so let's bring in David Traynor. I'm pretty pumped to have him on. Chief Executive Officer at New Constructs. He joins us on Zoom out of Nashville. And David, I first heard you talking about, I believe it was Tesla. And right now, that company is just ripping again. They're doing well because other car makers have been forced to recognize, you know, the dominance of the Tesla supercharger network. And I wonder, you know, what's your take on how important this is for the growth of EVs and for the global car market?
I think it's good for EVs. But more importantly, I think it's good for taxpayers that, given all the money that is flowed to Tesla, that they are making sure that that money is not spent to disproportionately benefit just one company. I'm not really so sure how it's such a good thing for Tesla that they're forced to open up their charging network to other cars and that other people can build to it. There's nothing proprietary about it now. It's really more a public utility. I don't really think they make any money in their charging stations. So I'm not at all sure about how this is good for the stock, but we've seen that stock go up for no good reason in the past before, and this just might be another one.
I always think, though, anybody who creates some kind of architecture or infrastructure, in the long run, David, it's a smart move. And maybe we don't pay anything for it yet, but I could see certainly in the future there some kind of significant revenue stream if Tesla becomes the de facto, you know, charging platform for everyone. No? Isn't that how we see it, or could see it?
Typically, it's really the other way around. I mean, how much did the person who invented the internet make? How much did the person who's invented blockchain make? How much did the person who, invented electricity, right? Or the electrical grid? These things that are public utilities tend not to be real money makers for individuals.
I mean, so I guess you could debate some of those, right? Because Satoshi could be sitting on billions of dollars if that were one person. But let's get to the market here, David, because we have had an incredible rally. And finally, by the end of last week, it was starting to look really broad-based as well. Today, there's a little bit of, I guess, profit taking, you could call it, or you could say maybe that rally was just a bear market rally. What's your view?
I think that these are it's really hard to tell these days because, look, we're only really in a bear market if the Fed's going to stand by their guns and bring inflation down and keep rates higher. If not, it's just kind of back to what we saw even in 2020 and 2021, where the markets were really, for the most part, just headed straight up. The Kava IPO, I mean, that was very reminiscent of the 2021 IPOs, ridiculously expensive on the front end, and then just got, even more ridiculously expensive when it went public finally and started trading. So, yeah, these are difficult times. I mean, I definitely think there's a lot more risk than reward out there. I think investors, as we always say, should be discerning about where they put their capital. Don't chase momentum. Don't chase FOMO. It's a recipe for disaster, even if it's pleasing in the moment. And otherwise, it's, I'm kind of out of the business. My crystal ball's in the shop and predicting where the overall market's going to go.
All right, AI, though. If you go to your, website, you guys talk about your research powered by AI. It's not a new thing. You've been doing this for a long time. How do you put the AI mania and euphoria in perspective?
Right. I think most people misunderstand, Carol, like how much goes into what is good machine learning and AI. They feel like it's this kind of magic wand formula or magic wand code that you just kind of wave over things and all of a sudden it can do things on its own. I think that there's a lot of really long-term diligent work that goes into making it useful. Most of the other stuff is smoke and mirrors.
Is NVIDIA,
right? So
is NVIDIA smoke and mirrors, or is that something you think is interesting?
NVIDIA's got a good business model, but is it a good stock? I don't think so. No, I mean, the valuation is long run away from it. I mean, we were bullish on NVIDIA, gosh, 7, 8, 10 years ago. I can't even remember how long ago. And it ran away from us from a fundamental perspective a while ago, because we think it's a good business, great returns on capital.
Yeah.
But the idea that any one company is going to earn the lion's share of profits as implied by the current valuation, we think is very unrealistic. This is yet another big technological fad. It may be as big or bigger than some of the others. I don't know for sure. But the size of the fad only makes the amount of competition higher.
I should say the current PE for NVIDIA is 212.
That's backwards, right?
It's an expensive
Yeah,
stock.
that's backwards. 57 if you look at a forward-looking PE.
Still high, right, David?
No, it's super high, and it's so high that it implies there will not be significant competition. And I just think that's a bad bet, right? I mean, anytime other businesses, non-NVIDIA businesses, think they can get into a business with that kind of valuation, they'll spend absurd amounts of money into getting into it to the point where, they were happy to lose money just to try to get a chance at that super high valuation, and that inevitably brings down returns and profits for the leaders in that sector.
All right, but what about investing around AI? We have a story on the Bloomberg about an Australian investor who is saying essentially the same thing as you are about NVIDIA or the companies that think they're going to own AI, but he wants to pick companies that he thinks will be enhanced or helped by AI, or companies that can never be competed with through AI. Do you think there are ways to invest around AI that make sense?
And just got about 30 seconds.
Yeah, no, I mean, I think, for example, like honestly, what we focus on, which is to deliver to the public a previously unavailable data set based on very deep analysis of footnotes. And the key to that, and the key to, I think, any really good AI, is that you've got a ton of very unique human expertise baked into it. It isn't without having gone through hundreds of thousands of filings and marked up all these different disclosure scenarios. If not for that, we would not have been able to populate our AI with the underlying intelligence it needs to create more value at scale.
people that are doing things like that are taking very specific and complex tasks and feeding that into a machine learning algorithm or machine learning or AI capability, that's where value is. But again, that comes back to unique human expertise.
Hey, come back soon, David. Really enjoyed this. David Traynor, Chief Executive Officer at New Constructs, an independent research technology firm, joining us on Zoom from Nashville, Tennessee. Carol Massar, Matt Miller, we're counting down to the close in just a moment. This is Bloomberg.
Your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. FedEx will be among the companies reporting minutes from now. Lee Klaskow follows logistics for Bloomberg Intelligence.
Also interested to see how much share gains they've gotten from UPS because of the labor issues that UPS is having right now. Obviously, there was some big news last week when the union decided that they gave their leadership the permission to strike if need be.
And you can hear more of that conversation on the Bloomberg Markets podcast. You can download it wherever you get your podcasts. Ahead of FedEx's report, shares are lower now by about 0.8%. A headline from the Bloomberg Professional Service, Dahmer producer Ryan Murphy will be leaving Netflix for the Walt Disney Company. Right now, Netflix shares up 0.6%. Walt Disney shares are lower by 1.4%. Avis Budget Group shares are higher after Morgan Stanley raised the recommendation on the stock to overweight from equal weight, noting that the car rental company's proven track record of managing fleet risk and keeping a lid on costs. Shares of Avis Budget Group up now by 9.5%. Nike shares are declining today after Morgan Stanley said inventory problems could weigh on margins in the fourth quarter, even as the bank predicts the sportswear brand will have mostly in-line results. Again, FedEx coming up after the close of trading. I'm Charlie Pellet. Those are some of our top corporate stories, and this is Bloomberg.
This is Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
All right, everybody, in just a few minutes, we're going to head over to Romaine and Scarlett, getting ready to wrap up the trade on this Tuesday. In the meantime, one story, I kind of sent this to you, Matt, and our producer, our YouTube producer, Ariel Agami, shared it with us, too, about a retired New York City police sergeant and two others convicted of acting as agents of the People's Republic of China, as well as on interstate stalking charges.
Stalking charges.
What is that?
I don't know. That's makes it even creepier. According to federal prosecutors in Brooklyn, the trio carried out an illegal law enforcement operation in the U.S. aimed at pressuring dissidents to return to China. The three defendants convicted on Tuesday were part of a group of 8 charged in October 2020. They participated in what became known as Operation Fox Hunt, which the Chinese government portrayed as an effort to track down legitimate fugitives, in quotes, legitimate fugitives. John Demers, then head of the Justice Department's National Security Division, said all this when the case was announced, but it's still
They harassed
concerning.
and conducted surveillance on a resident of New Jersey who wasn't identified, and his family in an unsuccessful effort to force them to return to China. Just interesting stuff. You know,
Oh my goodness. One victim was even told he had to make a choice between returning to China and committing suicide.
Allegations.
According to the government.
The government
yes.
alleged. You know what's our most read story on the Bloomberg in the past 60 minutes? That Titanic.
Oh yeah. Did they find the submersible?
No.
Listen,
no.
if you're going to make a submersible that's going to drop down to those depths, you've got to put like a sonar ping on the outside of it.
I don't know. I'm sure they had a lot of different things that should have been tracking it. No?
Yeah.
I mean, I don't know.
It's you know, the thing is, though, I was listening to a BBC reporter who went down in the Titan last year. And he said he had to sign an NDA first. That on the first page, he said death was mentioned 3 times and then mentioned over and over again throughout the document.
That's when you're like, you know what? I'm going to Disneyland.
They were like, there's 20 different ways that you could die here, so you need to sign and make sure you understand. Wow. Not that makes it any better. But
we're not making light of it. We really hope everything turns out okay. But it is what everybody is certainly tracking.
Gripped by.
I know. I mean, man, that's way down. And
I feel like they have about 48 hours of oxygen left.
That's what they were saying. So the clock is definitely ticking. All right, right now, ticking on the close of the trade on this Tuesday. We're going to head over to TV. Beyond the Bell starts right now.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Scarlett Fu. We're counting it down to the closing bell. Here to help take us beyond the bell. It's Carol Masser and Matt Miller once again. Welcome to our audiences across Bloomberg Television, Radio Originals, and our partnership for those folks streaming on YouTube. Carol.
Yeah, Romaine, we talked about it earlier. The home builder stocks really outperformance today, and this is a result of those U.S. housing starts surging to the highest since 2016. While home builder stocks at a record, they're up about 41% so far here in 2023, and we're talking about the highest, as I said, a record, or at least highest since 1995 in terms of our tracking. So really some outperformance here, Matt.
Yeah, looking into the index, we see that 9 of the stocks in the index are at least a 52-week high. They're really getting a lot of optimism from the new home starts. I wonder, though, if you have to cross your fingers that rates come down, or if these new home starts are all pre-sold. I honestly don't know, and I was asking some economists earlier, but it's not quite clear how many of these homes are built on spec. I don't know how much, Lennar, D.R. Horton, Pulte Homes, how much they do that anymore these days, but they surely do a little bit, and maybe they're getting a little bit ahead of themselves. On the other hand, they were assured by Jay Powell that the housing market has bottomed. So I guess.
Well, I think it speaks to the lack of inventory out there, right? I mean, rates have gone up and they're staying somewhat elevated. So people have made their peace with that, but they can't find homes available to purchase. So you end up constructing one.
That's right.
All right, we get the closing bells here in New York. Of course, this is a Tuesday afternoon, first trading day of the week, a holiday shortened week because of the Juneteenth holiday on Monday. And well, some of the enthusiasm that we saw last week tempering just a little bit here on this Tuesday. The Dow Jones Industrial Average down more than 200 points, or 0.7%. The S&P 500 down about 20 points, or 0.5%, while the NASDAQ Composite is going to finish the day out lower by about 0.2%. And the Russell 2000, that is lower on the day by about a 0.5 percentage point.
Yeah, and remain pretty broad-based selling. We're going to get into the industry groups, but if I look at the S&P 500, most names in the index, 405 to be exact, to the downside, only about 97, gaining some ground today. Matt, one unchanged.
Yeah, if you take a look at what's going on in terms of the industry groups, you can see consumer discretionary is the only winner there. Now, that does hold all of the home builders, which is interesting to think that home builders, that's discretionary, right? You'd think that's a staple, your house, but I get it. Also, the car makers.
You could rent.
You could rent, of course. The car makers are in there as well. Tesla is the biggest gainer, up almost 6% as Rivian and others agree to use its charger network. We had GM and Ford already agreeing to that over the past couple of weeks. GM and Ford, though, are down.
All right, so let's get to some of the individual gainers, if we may. Tesla, top in the S&P 500. In fact, the number one gainer in the NASDAQ 100, but also top among the S&P 500, finishing pretty much, Scarlett, at its highs, up about 5% here, pretty much becoming the de facto supercharger for the global auto industry. They signed up Rivian, so you got Ford, GM, now Rivian, and you've also got Elon said to be talking later on today here in New York City with Prime Minister Modi about maybe a Tesla factory in India. But Tesla's been on a tear. It's up more than 100% so far this year. PayPal also top in the NASDAQ 100 and the S&P 500. KKR agreeing to buy as much as $44 billion of buy now, pay later loan receivables from PayPal in a deal that basically now lets PayPal do more share repurchases. So that was a plus. That stock up about 3.7% here at the close, so just off its highs of the days. And I thought this was an interesting story. Lazard, a gain of about 1.8%, rallying, though, as much as 3.9% earlier in the session after Abu Dhabi Wealth Fund holding preliminary talks to buy the boutique investment bank. I just thought it's interesting. We've been talking so much about Mideastern, Saudi money in particular, and I just thought that was a
I think that's amazing. Yeah, Eric Chasker wrote a story about how the Middle Eastern sovereign wealth funds are like the marginal lender of capital.
Yeah.
And if they go ahead and buy Lazard, I think that would be in a story.
The new global Wall Street is what they're calling it, right? Okay, let's take a look at the decliners. The Dow was the worst performer on the day among the major indexes, and Boeing contributed 1/5 of the Dow's decline. And it was because of headlines from the Paris Air Show. Rival Airbus won a record order from Indian airline Indigo for 500 passenger jets. Boeing did not get that deal. And Alibaba, I know, Carol, you mentioned this earlier, the executive shuffle at the Chinese e-commerce giant. Executive Vice Chairman Joseph Tsai is back to serve as chairman. Eddie Wu will be taking over as CEO. And FXI, the ETF that tracks Chinese-related shares, falling as well, and Nike down to a one-month low.
All right, we're getting earnings right now out of FedEx, now crossing the wire. Revenue coming in a little bit light, $21.9 billion in the most recent quarter here. The street was looking on average for $22.65 billion here. Taking a look at operating income for the fiscal quarter here, we're looking at roughly about $1.5 billion in income, so a little bit of a miss there, and the net income coming in on a I'm not sure if this is GAAP or not, but net income coming in at about $1.5 billion, also looking a little bit light. Here's your forecast here for the full fiscal 2024 adjusted EPS. They're giving a range of $16.50 to $18.50. The street on average was looking for $18.31 here. So a wide range and a pretty big gap between the top end of that range, the bottom end of that range and what the street was looking for on average.
You could drive a FedEx truck through that range. That's pretty significant. Keep in mind that FedEx shares have been on a tear, you guys, this year, up more than 30%, way outpacing UPS, which is only up about 2.5% this year. But what's interesting is they've also been working on cost cutting, and I'm just quickly looking through the press release, Scarlett, and FedEx's president and CEO, Raj Subramanian, talking about becoming more flexible, efficient, and data-driven, but also talking about as we significantly lower our cost structure. So this has certainly been front and center for them, but certainly some disappointment with these numbers. They're also talking about operating results falling due to lower global volume. So we look at companies like this as an indicator of the global economy.
Yeah, as Kriti Gupta was just telling us, people like to look at FedEx as this barometer of the global economy and the macroeconomy. Certainly there is that part of it with the comment, as you mentioned, about the lower global volumes. And the CEO also talking about adapting to the dynamic demand environment. But a lot of the issues that FedEx needs to sort out is related to its cost structure that it took on during the pandemic, which puts it in a different boat, a different position than, say, UPS and DHL.
I can't believe that there's no mention of AI. I mean, who is advising this company that they put out an earnings press release and don't mention at all artificial intelligence?
Generative AI in the conference call, don't worry.
Yeah, it has to be there, right? Especially if you want to.
If I search on AI, I get aircraft.
Exactly. There's a lot of aircraft, but there's no artificial. There's no GPT. I looked through the whole thing. In any case, I think it is still an interesting bellwether, and I think a lot of people treat it as such for the economy. So it'll be interesting to see. I guess we can see now how the market's reacting.
UPS is down, too, in the aftermarket, down about 1.3%.
Yeah, well, we do get a conference call here, Matt, so maybe they will mention AI on that. But a lot of people are focused on some of these cost-cutting programs. And I think some of the cost savings that they're laying out in this press release, including the suspension of that drive program and the $2 billion that will save, you wonder sort of what's the level that gets investors a little bit more comfortable, because you can look at those numbers and you're still seeing a sell-off of, 5% or so right now in the stock.
Yeah, exactly. Right, so some disappointment. But again, go back to, Romaine, you talked about it, Scarlett, you talked about it. I mean, the 2024 adjusted EPS, $16.50 to $18.50, $2 range there. The estimate on the street is 18.31. So that is a pretty big standard deviation, several standard deviations, if you will.
We should point out, guys, here, just sorry to interrupt you here, now learning that the CFO is set to retire, Mike Lentz. That's the headline crossing the wire. Not exactly sure why or what the circumstances are, but there you have it.
That's interesting, especially because FedEx is doing so much on the cost side and has to really manage how it communicates that to investors. And he would be kind of one of the people in the lead job to do all of that. In addition to keeping a very close eye on costs, FedEx says that it sees CapEx for 2024 at about $5.7 billion. That is less than what analysts were looking for, which was about $5.98 billion.
Just to go back to this too. I just think this is interesting because he's been there for quite some time. Not necessarily as CFO, but he's been with the company for quite some time, and he got elevated to CFO, I think, right before Raja Subramanian took over here. So you wonder if maybe this is just part of him sort of putting his stamp on this, or whether maybe Mike just wanted to move on.
Yeah, 2005, right? He's been at FedEx. You're right, and taking over as CFO-elect in 2020. It looks like
that wasn't that long ago. After the pandemic kicked off, right?
And we talk about this. The CFO job has become so crucial in terms of running a company and figuring out strategy. So he was there during the pandemic, a very difficult time to say the least, and maybe he's just kind of like, I'm out, I'm done. But
he's a young guy to retire. He's 59 right now. I mean, I say this with so many people still working when they're in their 70s.
I say this with a little tinge of jealousy.
Interesting. And we'll continue to watch this certainly in the aftermarket because we're definitely seeing a trade. All right, guys, that is a wrap. Our cross-platform coverage, radio, TV, YouTube, and Bloomberg Originals. The team, we'll see you again, same time, same place at 3 p.m. tomorrow. Aftermarket. I just want to pull it up on my Bloomberg because we did see it down What do we?
4.6%.
Down 4.6%.
There was a bug. There was a bug on the screen.
It's down 4.6%. Okay, and it's dragging UPS down as well, which is down about 1.25%. They're not apples to apples, which is always important to point out when we talk about these two companies. Let's get to it though, with our man on the job when it comes to FedEx. And
Lee
with us
Klasko
is
joins us.
He does.
Senior Transport, Logistics, and Shipping Analyst at Bloomberg Intelligence. And Lee, for those who aren't, deep into this, what are the important differences between FedEx and UPS?
One's purple and one's brown. No,
thank you very much. It's been great talking to you. See you later.
No, different models. You know that.
There's a lot of differences. Obviously, first and foremost, is UPS is a union. Their employees are unionized. They're represented by the Teamsters, where FedEx has a mix of employees and third-party contractors. A lot of the folks that deliver for their ground network are really employed by small businesses that are independent contractors. And that's really the biggest difference. And another difference is UPS started as a ground network and grew an air fleet, and FedEx started as an air fleet and then grew a ground network. So there are little nuances behind that. And then also, I would say one of the biggest differences is UPS started its transformation about 3 years earlier than FedEx, and FedEx has been playing catch up to UPS. Carol Tomé, the CEO of UPS, has done a fantastic job of really focusing on what's important for UPS, getting rid of unprofitable businesses, getting rid of the fat, if you will. They got rid of their less than truckload business, which was marginally profitable and during good years. And so that has freed them up, not only freed up capital, but also freed them to focus on what they do, I guess, better than the LTL business.
A woman named Carol, what's not to love? I'm just going to say no. Hey, let's go back to FedEx in terms of their...
We were on CFO just now, weren't we?
Well, we were talking about UPS.
We
were talking about UPS.
Yeah. But while we're on CFO, let's get back to FedEx and ask what the deal is with Mike Lentz. I mean, was he planning to retire? As Scarlett points out, he's fairly youthful. And we noticed that he's only been the CFO since June of 2020. So what's the deal?
Yeah, I'm not really too sure about that. He's been in the role for under 3 years, like you mentioned. I don't really know if it's really a shakeup of the C-suite or if it's just, he just said, I want to go play golf. I really don't know what the rationale is there. I think the movement on the stock really has nothing to do with the CFO announcement. It's really about the guidance. This fourth quarter was fine. Nothing, nothing to get excited about. Nothing to get depressed about either. But I think that people were expecting maybe a little better outlook. I think you guys mentioned earlier that the low end of the range is pretty far from where consensus is. And I think that people were looking for maybe a slightly better earnings. But what I would say is I'm assuming that management there are being extremely conservative. They had a track record, shall we say, of not executing. So I think they don't want to disappoint. So my guess is that they're coming in low and hoping to move up from there. But they're really there's things that are within their control, and there's a lot of things that are not within their control. Obviously, on the demand side, they're doing all the right things when it comes to pricing. They're starting to do all the right things in terms of the restructuring of their networks into one. They announced that they're combining the ground and express in Canada. Obviously, that is a step in the right direction. This is going to be, this is going to take time. It's going to take a lot of time for them to make inroads on that, especially to do that for their whole global network. But what we should see is more freight moving through its ground network when it makes sense for the company, and that should do well for margins.
When a company, FedEx or other, puts out a 2024 adjusted EPS of $16.50 a share to $18.50 a share, I mean, that seems like a huge gap. I mean, should we see it as a huge gap? And is it just that they're so uncertain, or how do you kind of analyze that?
I don't really think so. I mean, it's we're talking about earnings per share in the teens. We're not talking about 20 cents, right? So obviously the dollar amount's going to be a lot higher. The percentage, I don't think, really is so out of whack with what a lot of other companies provide in terms of guidance. I think to your point, there's a lot of uncertainty out there. There's still a risk of a U.S. recession. We don't really know what's going on with China. Are they going to increase stimulus? Is that going to, help that economy? FedEx is pretty big in China, so that's been a kind of a drag on their results, kind of the slow reopening of China and the related Asian markets. I think there's just a lot of uncertainty for them. They don't know, they're going to try to combine these networks in certain regions. It could happen faster. It could happen slower. There's a lot of unknowns out there. And of course, the U.S. economy, there's still 65% probability of it going to recession, according to consensus on the Bloomberg terminal. So, there's still that they might have to contend with. We've been in a freight recession for quite some time, whether if you're talking about parcels, trucking, railroads, and that's really just a re-normalizing from the shocks of the pandemic. Supply chains are finally getting back to normal. Rates are coming down across the board, no matter what mode you're talking about. Some have fallen a lot. Some have just slowly declined because maybe they're not getting surcharges or accessorial fees. But we are seeing a more normalizing of rates and of demand. So I think that's something to consider as well.
Is FedEx, Lee, you think, a better bellwether for the U.S. economy than UPS, or vice versa?
No, I think they're both the same. I think they all cut pretty similar customers. The big difference at UPS is Amazon is still a sizable customer of UPS, where FedEx is pretty much doesn't really deal with Amazon. Maybe on the margin, but it's really UPS has been a service provider for Amazon still, and one would just assume that's lower margin business just because of the scale. And UPS has, said they're looking to, maybe walk back that concentration. They still want Amazon to be a customer, but maybe not such a large percentage. And we should see that probably decline over time. So I think that's another difference, when we started the segment. But at the end of the day, I think they're both bellwethers. The only thing that I would say is FedEx might be a little bit more all-inclusive because they still have that less than truckload business that I mentioned that UPS divested in. And that business is usually associated with manufacturing and industrial. They do other things like consumer retail, e-commerce as well,
Right.
but the majority of it's manufacturing and industrial.
How come FedEx has been such an outperformer versus UPS this year? UPS is up just shy of 2%. FedEx is up 33%.
Easy comps. They just underperformed for so long. They're finally getting their act together.
I mean, if you look at the 5-year comp, UPS is killing it, and FedEx is still below the line. So
playing
barely.
catch up here,
Yeah.
as you said.
Sentiment on FedEx was so low last year. For a number of issues that they've had, a lot of issues with executing, and I think that the street is finally seeing that the company is finally realizing that it needs to trim the fat, get more productive, and they have a plan for it, and let's just see if they execute.
Hey, real quickly, just got about 25 seconds, Lee. What's the number one top of mind question for the analyst call, at least for you?
For me, it's probably Network 2.0. I would want to know a little more about what's going on in Canada, what the actual process is, what are the benchmarks that we can see over time just to show that they're actually making progress.
Mm-hmm.
Because again, FedEx was a story that it was not executing, and people want to hear and see and feel and touch that they're executing. And if people have that confidence, FedEx is a great long-term story, right, because of all the things going for it.
Another headline: FedEx Express revenue for the fourth quarter, $10.41 billion versus an estimate of $10.76 billion, so just a hair light. Lee Klaskow, thank you so much, of our Bloomberg Intelligence team, joining us on Zoom in New Jersey.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:21 on Wall Street. We do check markets all day long on Bloomberg. We're keeping an eye on FedEx shares after hours. They are lower now by just about 3.9%. FedEx delivered a 2024 profit outlook below analyst expectations as a drop in package demand offsets CEO Raj Subramanian's $4 billion cost-cutting plan. FedEx now sees adjusted 2024 EPS in the range of $16.50 to $18.50. Estimates were for $18.31, so a broad range there. Lee Klaskow follows the logistics industry for Bloomberg, and he was a guest right here on Bloomberg Business Week.
There's a lot of uncertainty out there. There's still a risk of a U.S. recession. We don't really know what's going on with China. Are they going to increase stimulus? Is that going to, help that economy?
And you can hear more of that conversation on the Bloomberg Business Week podcast. You can download it wherever you get your podcasts. Again, after hours, FedEx shares now down by just about 2.7%. Down day on Wall Street today with the Dow, the S&P, NASDAQ all moving lower as the second quarter rally cools with investors jittery ahead of tomorrow's testimony from Fed Chair Jay Powell. S&P down 20 points, a drop today of about 0.5%. Dow Industrials down 24, decline of 0.7%. Actually, the Dow down 245 points today. We had NASDAQ down 22, a decline of 0.2%. 10-year yield 3.71%. The 2-year down 4.67%. Spot gold lower by $12 the ounce to about $19.36 the ounce. And West Texas Intermediate crude 71.25 a barrel, a drop today of just about 0.9%. So again, to be sure, the Dow down 245, down 0.7. S&P down 0.5%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thanks so much. Carol Massar along with Matt Miller live here on Bloomberg Business Week. And I had a lead all set up, but then Ed Ludlow tweets and he says, two big tweeters, Elon Musk and Narendra Modi, reported to be meeting this evening. I had no idea there were two big tweeters, Ed. I know Elon is, but the Prime Minister of India?
The Prime Minister of India is a big tweeter, and he's been a tweeting. The thing is, he's not yet a tweeted about the meeting with Elon Musk, but one wonders whether he'll tweet after the meeting because, Musk has just been on this grand tour of Europe meeting world leaders, shaking hands, and after every opportunity, the world leader can't help themselves. They want to tweet that photo with the man himself.
By the way, is India a huge opportunity for Tesla?
Big time. I mean, this is the story. But it's interesting because there's kind of some wrangling on both sides. So we should say, we understand that Musk and Modi will meet this evening according to a Bloomberg source, and that there will be a meeting with a number of other high-profile people. But we know that Modi's here as well to see President Biden at the White House later in the week. The reason I say there's wrangling is that talks between Tesla and India just restarted. India's a massive market, right, Matt? Just literally by the sheer volume of people there. But the problem is that they have quite heavy tax on imported vehicles. And the Indian government has done all it can to stop Tesla from importing Shanghai-built Teslas into India and pushing them very aggressively to build a factory actually in that country instead so that they're produced domestically.
Does Elon want to build in India?
Well, the origin of this story kind of goes back a year where when he was asked about India, Musk tweeted exactly that they want a level playing field where there are not such heavy penalties on importing cars because Tesla at that stage wanted to test the market out. The average household income in India is very different to this country. Electric vehicles are very expensive. And so this kind of import tax that India had in place, it was a concern for Tesla because they'd have to price it, aggressively, and perhaps that wouldn't allow them to do so well. What we understand, Bloomberg sources tell us, is that those talks kind of restarted in earnest in May about this idea that Tesla wants to not only sell vehicles in India, but it wants to build them domestically as well and work towards a factory.
It's so cool. It's so cool. I mean, highlighted by the whole opportunity of an Indian market to me is amazing, highlighted by the orders that we saw for planes, right? From Indigo,
It's massive.
A 500 plane order for Airbus, and I know Air India also ordered about 500 planes this year. So, I mean, that's just a ton of metal.
It's been the other big emerging market, right? I mean, we've focused on China for how many decades now? But if you think about it, I feel like we're getting a lot more clarity. We did the story last week, right, about the financial sector, right, in terms of India in particular. So there's a lot that I think we don't realize about the potential, not just the market side.
Now, Ed, when you charge a Tesla,
did we give him his props? Co-host of Bloomberg Technology.
What? Oh, that's so
Bloomberg
kind.
News, San Francisco Bureau.
And he's our greatest rocket reporter. He's the best
he's pretty
EV reporter
amazing.
around.
We need to give him some love.
We love you, Ed.
Okay, all right, now we can go.
Now, if you're charging a Tesla in Europe, is it different from charging a Tesla here? Or if you're charging a Tesla in China, is it different from charging a Tesla here? Do they have different, adapters or plugs, just like the electricity plugs that we have in our walls?
Yes, so the story is playing out here in North America, where Tesla's own self-developed standard, the North American Charging Standard, or NACS, is what it uses. And we'll talk a bit, I think, about the other rivals here in this country that are coming around. But as a rule, in other markets, Europe, China, Tesla conforms to the standard of that market. So in Europe, Tesla conforms to CCS. In Europe, in China, the kind of just Chinese domestic standard, Tesla plays by that rule as well. And of course, all of these are circumventable with adapters. But the bigger picture is winning over your industry peers and rivals to your way of thinking.
And they have done that, right? Because we saw first Ford and then GM and now Rivian. Are we still waiting for Stellantis and
VW? Like who? Like
VW?
Is everybody going to just join on?
Yeah, it is fascinating. So Rivian happened today. That was the big news, and it really boosted Rivian's share price. They jumped like 5.5%, closed at a March high. And it was really interesting because it was probably a bitter pill for Rivian to swallow. You know, they wanted to be their own person, their own electric vehicle startup. They're actually building out their own CCS charging network, which they say they're committed to. But the news is that from next year, Rivian owners can use the Tesla charging network with an adapter. And then from 2025, they'll start building their vehicles modified to reflect that Tesla standard. And you're right, we framed this in the Bloomberg News story about the domino effect. So Ford happened first, then GM. Rivian's followed very quickly. A number of independent charging providers have basically said, sure, we'll offer NACS as well. So the big questions are the European automakers who sell many cars into this country, and then Stellantis is a big one. Stellantis have told Bloomberg that they're thinking about it. Well, it's not really an answer, is it?
We're considering it.
Yeah.
They're just waiting to put the press release together.
So help us out here, Ed, because we talked with David Traynor over at New Constructs, and he didn't necessarily think this was going to be a big revenue generator, for Tesla. So I'm curious how you see it.
Yeah, the biggest question I have is what the arrangement is with Ford, GM, and Rivian. In other words, is this as simple as a Rivian owner driving up to a Tesla supercharger and then Tesla charging them a fee? If it's as simple as that, it's hard for us to quantify. There have been many studies, right? I think Piper Sandler saw a $3 billion boost to the top line by the end of this decade. Goldman Sachs had put together a report saying that it could be a $6 billion boost to Tesla if they ever opened up their supercharger network. That was a piece of research done, I believe, just before the pandemic. So we don't know. The bigger question I have is what money changed hands initially? In other words, have Ford, GM, and Rivian had to get the checkbook out to get access in the first instance to their cars, to the network? Forget about, the per charge cost to the driver. That would be really interesting if Tesla made them contribute to the capex cost to build out a network. For example.
They should. I mean, they got to put their money where their mouth is, right? Tesla, Elon Musk is really the only person, company, or country to seriously invest in a network. I mean, the other charging networks that I've used in Germany and here in the U.S. seem really weak and broken and crowded.
Well, it's kind of first mover advantage. They did invest early and heavily, but the reality is there are more NACS standard chargers in the US than all of the different CCS providers put together. In other words, Tesla's network is bigger than all of the players who are focused on the other standard combined. And it's just more reliable, therefore. It has a sexy brand image. And I think that if you listen to Jim Farley and Mary Barra when these deals were announced, they really leaned into this idea like, yeah, you know what? This is super reliable. And if we know it works, let's give it to our customers.
One less thing we have to worry about. Hey, just real quickly, 30 seconds, but doesn't it also mean Tesla potentially gets to tap into any kind of money, infrastructure spending to build these out, whether it's in the U.S. or elsewhere? Is that another thing that they get to access potentially?
Yeah, there is billions of dollars available through the infrastructure bill. You wonder politically how much more leverage this gives them. Everyone else being on board with their tech. Because remember, this is a tech story. It's a different type of charging tech.
That's what I talked about, like infrastructure, right? When you create the, platform, it's got to be valuable in some ways.
The
but
standard.
I guess time will tell. The standard, right? The architecture. Ed Ludlow, thank you so much. Also,
I missed you guys.
Yeah, good to have you here. Also a big tweeter.
I am. Thank you.
Ed Ludlow is co-host of Bloomberg Technology at Bloomberg News in our San Francisco bureau. Catch him and Caroline Hyde every noon.
Every day at noon.
Every day at noon, Wall Street time, right?
And it's really cool because it's a transcontinental show. Caroline's here, Ed's there.
Yeah, it is, across the country. All right, right now let's get a check on world and national news. We're staying on the East Coast here. We're heading to D.C. and Nancy Lyons. Hey, Nance.
Thanks, Carol. President Biden is meeting with artificial intelligence experts in San Francisco this afternoon. The president and tech leaders are discussing how to manage the risks of the rapidly advancing technology. Well, President Biden's son, Hunter, will apparently plead guilty to 2 misdemeanor tax crimes and enter an agreement with prosecutors to potentially avoid a charge for possessing a gun while addicted to an illegal drug. A Trump-appointed prosecutor in Delaware brought the charges. Republicans like Senator Lindsey Graham have largely been criticizing the agreement.
The questions that a lot of people have on our side, is this a sweetheart deal? Why did it take 5 years to come up with these charges?
Senator Graham says there are a lot of questions yet to be answered. The Bidens have issued a statement saying that they love their son and support him as he continues to rebuild his life. The classified documents trial that former President Trump is facing will start on August 14th. That's the trial date set today by the judge in the case, Aileen Cannon. Motions from the defense are expected to prevent the actual start, though, on that assigned date. Multiple vessels are on the scene continuing the search for the Titan, a missing submersible with 5 people on board on an expedition to view the Titanic wreck. Teams are searching from the air, the surface, and using a remote operations vehicle, or ROV, to search below the surface. U.S. Coast Guard Captain Jamie Frederick was asked about how they'll retrieve the Titan if it's found.
Right now, all of our efforts are focused on finding the sub. What I will tell you is we have a group of our nation's best experts in the Unified Command, and if we get to that point, those experts will be looking at what the next course of action is.
Captain Frederick says it's believed the submersible has less than 40 hours of oxygen left. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:40 on Wall Street. We do check markets all day long here on Bloomberg. The Dow, the S&P, NASDAQ all declined today. Stocks edge lower as the second quarter rally cooled, with investors jittery ahead of Fed Chair Jay Powell's testimony tomorrow and also Thursday. S&P 500 index today down 21 points, a drop of about 0.5%. The Dow down 245, drop there of 0.7%. NASDAQ down 22, a decline of just about 0.2%. 10-year yield 3.71%, with a 2-year 4.68%. Gold down $14 the ounce to $19.35, a decline of 0.7%. West Texas Intermediate crude oil down 1.1%, $71.15 a barrel on WTI. Bottom line, down day for the Dow, the S&P, and NASDAQ. As for the overall market backdrop, David Traynor is the CEO of New Constructs, and he was a guest right here on Bloomberg Business Week.
Look, we're only really in a bear market if the Fed's going to stand by their guns and bring inflation down and keep rates higher. If not, it's just kind of back to what we saw even in 2020 and 2021, where the markets were really, for the most part, just headed straight up.
And you can hear more of that conversation on the Bloomberg on the Bloomberg Business Week podcast. You can download it wherever you get your podcasts. Again, recapping, it was a down day on Wall Street. FedEx, after the closing bell, reported earnings. FedEx shares down now by just about 2.6%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Master along with Matt Miller in for Tim Stanovic, and you're listening and watching Bloomberg Business Week on Bloomberg Radio, on YouTube, and on Bloomberg Originals. We're going to talk a little bit about kind of the HR environment, because we've seen a small but growing list of big name companies, including BlackRock, Disney, Chipotle. They are taking their return to office mandates up a notch, calling employees back to their desks 4 days a week. We've been calling it the RTO creep in terms of getting people back to the office. We talk about this a lot. We talk also about how workers are interested in balance. They're also interested in wellness issues. So we thought we'd get into that a little bit, Matt.
I'm looking forward to it. I've never worked from home.
You never worked from home? Oh, when you were during the pandemic,
never.
You never
During the
did?
pandemic, I went to the
Is that 'cause
studio
you couldn't?
every single day.
Was it like almost not possible?
It just seemed a little bit difficult in my role on TV, and we had a studio that was fully robotic in Berlin. So we just sent everybody else home, and I was the only person in the office. Wow. However, I would love the opportunity to work from home every day, because it would mean a totally different relationship with my household, with my daughter and my wife. And I feel like the work-life balance that I could achieve working from home would be far better than the one I have to endure commuting into New York City every day.
All right, well, I'm guessing our next guest has some thoughts on this. Holly May is Global Chief Human Resources Officer at the $28 billion market cap company Walgreens Boots Alliance, and she joins us on Zoom from Deerfield, Illinois. Holly, nice to have you here. We do have some strong thoughts on this and opinions, as you can tell. First up,
as most people do.
First up, if you will, it's so great to have you here. Talk to us, if we may, on the general macro environment for hiring. What does it look like right now? Is the labor force still tight? Are you having to pay up, or are things easing? What are you guys seeing?
I really would say it depends on the area of the business where you're hiring. We're seeing things loosen up quite a bit, but there's still some competition in some key skill sets and areas.
So it says to you it's not as tight as it was a year ago, coming off the pandemic.
Absolutely.
All right, having said that, what are the things that workers want? Matt was talking about, working from home. I did work from home during the pandemic and did my broadcast. And it was kind of nice not to have to commute. I got 2 hours back of my life, which was kind of cool. And
to me, that's the killer. It's the commute.
And I did the show in
if my
yoga
office
pants
were next door to my
Fairfield.
house, that would be another story.
So talk to us about what workers want.
I think what you see is it varies from company to company, and that's something we've done at Walgreens. We've stayed really close to our people through focus groups, through our surveys, just to make sure we have a good understanding of what it is they're looking for, what it is they need. And in terms of remote work, we've really adopted in our support office a leader-led hybrid philosophy, which means that really defining moments that matter depending on the area of the business. So in our support center, that could be a town hall, a moment to come in and socialize, to get know your colleagues, so that when you do go remote on days where you work from home, that you've forged those relationships, so perhaps collaboration looks a little easier.
So you have at Walgreens proclaimed a real commitment to improving mental health and well-being. This is something that, well, I hear a lot here at Bloomberg as well. We care about your mental health. We care about your well-being. Does that show results in terms of performance? If you really do dedicate yourself to your employees' mental health and well-being, do they pay you back by being better workers in the long run?
Well, I would say our vision and philosophy for our team members, which are our employees, is really to deliver for them as whole humans, really to deliver for them on both the personal and the professional side. And we feel that when they can come to the office and really show up as their authentic selves and really connect with their leaders, that's when we're going to get the best performance out of them. So what we're looking at is delivering on their whole selves. So mental health is a big component of that. We introduced a new program called Be Well Connected last year in May during Mental Health Awareness Month, where we really delivered a trio of solutions and platforms, given we knew that our workforce, whether it be in our stores, in our distribution centers, or in our support centers, needed to receive that support in very different ways. So we partnered with Journey Live for a series of mental health related classes and support. IndieFlix is the second of those solutions. And then our EAP solution rounded that out as the third.
Wait, so Holly, break it down for us. So how does it work? You're partnering. So what does it mean for, is it employees, younger employees, or family members of employees? What does it really mean?
It's for employees and their family members, as well as their larger communities and networks. So Journey Live, as a great example, it's a web-based, is also an app solution that has these on-demand classes. They can also be experienced live on a variety of mental health related topics. And we extend that membership to the app, that subscription service, not only to the employees, all of their family members and their external networks of friends or different relationships that they might have. So with that, it's been a great partnership for us because they have really partnered in helping deliver customized content. So most recently, we developed a class for pharmacists specifically, as well as for families, parents and caregivers of children with special needs. So we're listening to our people, we're trying to better understand their needs, and then we're delivering on that.
So what made you guys, because forgive me, but there's lots of conversations about companies and their caring of wellness and for their employees, but what was it that made you guys said, it's not just talk anymore, it's something we had to do? Did something happen within the company, or what was it? What was the final catalyst? And forgive me, just got about 30 seconds or so.
Yes, of course. It was listening to our employees and also recognizing in a recent survey, we've seen that 90% of this country believes we're in a mental health crisis right now. So making sure we were delivering on that for our people and also ensuring we had solutions that met them where they are.
Does it? Yeah, okay. We'll have to continue this conversation because there's a lot that goes on around this. Holly, thank you so much. Really appreciate getting some time with you. Holly May, she's Global Chief Human Resources Officer at Walgreens Boots Alliance, on Zoom from Deerfield, Illinois. Would you really work at home? You seem to like coming to the office.
Well, I do like having a separate environment to do my job. I just, like I said, I don't like the commute. So
I know. It makes it hard.
It would save me 2 hours a day of kind of frustration And when you're commuting, you're usually with a bunch of other people who also don't want to go where they're going.
I'm on the show planning call with you when you're on in the car, the beeping and
yeah, beeping is a nice way to put it.
Yeah, it is. All right, we're going to come back in just a moment. Carol Massar, Matt Miller, this is Bloomberg.
company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. We're keeping an eye on FedEx shares after earnings. Right now, we've got FedEx down 2.6%. It gave a 2024 profit outlook that was below analyst expectations as a drop in package demand offsets CEO Raj Subramanian's $4 billion cost-cutting plan. Paris Air Show underway with Airbus pulling in a record order from Indian carrier Indigo for 500 A320 family aircraft. Bloomberg Radio was there, and we caught up with Guillaume Ferry, the CEO of Airbus, and we asked him about signs of froth in the airplane building business.
So I think there is a lot of substance behind those orders. It doesn't change the short-term perspective on ramping up the production because these are long-term orders. So I think it reflects the fact that planes are scarce resources, but it also reflects growth that is a reality, and it reflects long-term perspective and planning of airlines. So I think this is a healthy perspective on the long-term future of aviation.
And you can hear more of that conversation on the Bloomberg Markets podcast. You can download it wherever you get your podcasts. ADRs of Airbus up today by 0.9%. Boeing lower by 3.5%. Eli Lilly is paying about $2.4 billion to acquire Dice Therapeutics, a biotech company that is developing oral treatments for immune diseases. Lilly up by 1% today. Dice surged 37.2%. Those are our top company stories at this hour. I'm Charlie Pellet. This is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenovec on Bloomberg Radio.
Matt Miller here in for Tim Stenovec with Carol Master in the Interactive Broker Studio. We've still got a lot ahead. Joel Weber is going to come in, and I'm really looking forward to the editor of Business Week talking to us, as well as Austin Carr, the technology reporter, about NVIDIA and the incredible explosive growth of AI. Right now, I want to get down to Nancy Lyons for a check on the world national news. She's in the 99.1 newsroom in Washington, D.C. Nancy?
Thanks, Matt. So far, an air search has failed to find a submarine that was headed to the wreck of the Titanic. So now the effort is shifting underwater, led by the operator of the mission. For the latest, we go to Bloomberg's Irv Chapman.
Rescue equipment is being dispatched to the scene as quickly as possible, Coast Guard Captain Jamie Frederick said.
Right now, all of our efforts are focused on finding the sub. We have a group of our nation's best experts in the Unified Command. Those experts will be looking at what the next course of action is. Our crews are working around the clock to ensure that we are doing everything possible to locate the Titan and the 5 crew members.
France has dispatched a research vessel equipped with an underwater robot. In Washington, Irv Chapman, Bloomberg Radio.
House Speaker Kevin McCarthy is calling Hunter Biden's plea deal a sweetheart deal. Today it was announced the president's son has agreed to plead guilty to tax misdemeanors and enter a diversion agreement related to a gun charge. McCarthy says the plea agreement shows there's a two-tiered system of justice in America. He adds House Republicans will continue to look into the Biden family.
Now, this does nothing to our investigation. It actually should enhance our investigations because the DOJ should not be able to withhold any information now, saying that because of pending investigation, they should be able to provide Chairman Comer with any information that he requires.
Speaker McCarthy is not the only Republican crying foul about Hunter Biden's plea deal. Former President Trump says it's proof the system is broken. Meanwhile, President Biden, while meeting with tech experts on artificial intelligence this afternoon, was asked if he'd spoken with Hunter. He didn't answer the question, but he did say he's proud of his son. Former President Trump learned today he will be going to trial in August in Florida for his alleged mishandling of classified documents. Federal Judge Aileen Cannon announced a trial date of August 14th. And of course, the Trump team is expected to request a delay. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Now back to you, Carol and Matt.
All right, thank you so much, Nancy Lyons in our 99.1 News in Washington. I just mouth to Matt. I'm like, what do you want to do? We're going to talk about a story, and I put out two different stories.
Some stories are a little bit too, because
I've never seen you panic. I'm like, and you mouth to me, and I'm like, I have no idea what you're saying to me. But your look of panic was
There are some things that really grind my gears. Have you ever noticed? And then I go on a rant, and I'm trying to avoid doing that.
So I'm guessing you want to do the second story.
I'd like to talk about something that doesn't drive me bonkers.
Spotify?
Yes, I don't care about Spotify.
Oh my God, you just never have panic on your face. That was so funny. All right, so Spotify is planning a more expensive subscription option, a premium tier, basically.
Okay.
Expected to include high-fidelity audio in an effort to drive more revenue and placate investors who've been saying the company should raise its prices.
I'm not a user of Spotify because you know what? Yeah. I think as someone who is already fully immersed in the Apple ecosystem,
me too.
I just find it